all the talk in this country, Ian, is of interest rates going up, and yet in Europe, they're going down again.
Well, they are, and that's a reflection of the different state of the economies and the different time in the economic cycle that we face relative to either the United States or to the European Union or the rest of the European Union, the Eurozone. Why did we not cut rates further than we did? I think the answer is twofold. One is that it's not clear when you cut rates at very low levels quite what the impact on the economy is going to be once you get very close to zero.
So you don't see rates going lower than they currently are? Well, you can't say ever, but certainly in the near future.
Well, I think we took the view that for the UK, given the particular structure of the banking system and the way in which people respond to the level of bank rate, that 0.5 was effectively as close to zero as we could get at the time that we were considering lower rates. That's not to say that in other countries the differences in the economic structure does not mean that they cannot do different things, but we felt that 0.5 was probably practically
but the mood music, particularly among economic commentators, is that interest rates are more likely to go up than down in the next few months. I gather one of your colleagues every month recommends that they should go up now. Is that right?
That's not according to my understanding,
No?
certainly. I mean, what we have said is that the time when it becomes appropriate for interest rates in the UK to start to rise back to a more normal level is approaching. But we've also said, one, that we think there is scope for the economy to grow a little further before we really get to that point. And secondly, once we get to that point and thereafter, that any rises in interest rates that we anticipate, we hope will be only gradual for quite some time to come.
But it seems to me that we're looking at that probably sooner rather than later, maybe before the election. Mark Carney, when he first took over at the Bank of England, he said, well, when unemployment got down to 7%, that's when interest rates would go up. I think unemployment now is 6.8%, so it's imminent, isn't it?
Well, it's not what he said, to be frank. What he said was...
that's what most people think he said.
That may be the case, but certainly what he said and what we attempted to communicate strongly to everyone around the economy was we would not even consider raising rates at least until unemployment fell to 7%. But we did say also at the time that we felt unemployment could fall a lot further without there being significant inflationary pressure.
Would it be true to say at your monthly meetings the discussions on whether interest rates should go up now are slightly lengthier than they might have been a few months ago?
Well, I think the meeting lasts about the same amount of time. What we
That's
have
not
said,
what I asked.
What we have said, and what we said in the last minutes that were published, was that the decisions were becoming more balanced. I think a year ago, with the economy flat on its back, it's a very easy decision to make as to quite what the appropriate level of interest rates is. After a year of relatively strong growth, in which we have seen a sharp fall in unemployment and some very modest improvement now in nominal pay scales, although that's still very modest, then you have to say that the decision becomes more balanced. But as I said before, I think the view amongst the committee is that given the depth of the recession and the loss of GDP that we faced over the course of the crisis and the ensuing recession, we can still see the economy running a little bit longer.
Because we're not quite yet back at 2008, are we?
No, I think that's probably likely next quarter.
Dave in Essex has texted in, when do you think rates will rise? If you were buying, would you get a fixed rate or a tracker? If you're buying a mortgage, I guess he means.
Well, let me get the point about housing advice out of the way first, which is particularly under the new mortgage market review. People have to be very closely trained and qualified to give mortgage advice.
You must be qualified. You're on the Monetary Policy Committee.
I'm not qualified under the law, and so I would be breaking the law and could be
as a punter
taken out of this studio by the police if I were to give advice. So I cannot give advice on individual mortgages, I'm afraid. In terms of when rates will rise, I honestly do not know the answer.
But from what you were saying earlier, if I interpreted what you were saying earlier as probably towards the end of the year, that's when we could seriously expect a prolonged discussion in your committee.
I think the first thing to say is it's going to depend critically on how the economy performs over the summer and through the autumn. We do think that there's a scope for the economy to grow a little further before we have to start the gradual process of normalisation. That's going to depend on how fast growth is in the second, third and fourth quarters as to exactly how fast we are absorbing slack in the economy, and therefore when it becomes appropriate to rise. And the second reason I don't know is that, of course, one of the beauties of the Monetary Policy Committee is it's 9 people.
And you've got a lot lot of new people on it, haven't you?
We
'Cause
will do
It's
over
not.
the
It's
course
not
of
just the same people over the course of the years. You got some new members coming on.
We do. We have one of the, I think, quicker turnarounds in the history of the Monetary Policy Committee, in the sense that by the autumn we will have, I think it's 4 new members.
But you're staying.
My term carries on till September 2015.